Ray Dalio, often called the Steve Jobs of investing, has just sent shockwaves through Wall Street with his bold first quarter 2025 portfolio shakeup. While the broader market soared, Bridgewater Associates, Dalio's legendary hedge fund, made headlines by dramatically slashing its positions in high-flying tech giants like Meta, Alphabet, and Nvidia, trimming more than $1.5 billion combined from these holdings. But don't mistake this for a retreat from technology. Instead, it's a calculated pivot, a repositioning toward three tech titans that Dalio believes are set to dominate the next era of artificial intelligence, cloud computing, and global trade. Let's break down the logic behind Dalio's latest moves and see why he's betting big on a new tech trifecta. Dalio's actions go far beyond simple selling. In a market environment defined by persistent inflation, ongoing Federal Reserve uncertainty, and increasing geopolitical risks, Bridgewater's portfolio changes reveal a sharp focus on companies with enduring business models, robust cash flows, and resilience against global shocks. The message from Dalio is clear: adapt to the changing landscape or risk getting left behind. Bridgewater boosted its Microsoft stake by an impressive 21% in the first quarter, adding 142,000 shares to its portfolio. The rationale is straightforward. Microsoft's software-centric business model is built to weather economic storms and thrive during periods of volatility. AI leadership. Microsoft's deep integration with OpenAI and its Copilot AI tools has fueled Azure's explosive 20.8% year-over-year growth in the first quarter, easily beating Wall Street's expectations. Financial strength. The company reported a staggering $70.07 billion in revenue for the quarter, up 13.3% year-over-year, and delivered record earnings per share of $3.46. Operating margins soared to 45.7%, highlighting Microsoft's ability to scale profits even as it grows. Geopolitical safety. With just 6% of its revenue coming from physical products, Microsoft is largely insulated from global trade tensions and supply chain disruptions. Dalio's bet is simple but powerful. Microsoft's dominance in enterprise software and AI infrastructure makes it a forever stock in a world that's becoming more fragmented and uncertain. With $94 billion in cash reserves and AA credit ratings, Microsoft combines growth with fortress-like stability. Its ambitious $100 billion capital expenditure plan for AI data centers aligns perfectly with Dalio's focus on structural resilience. As cloud adoption accelerates, remember, 85% of IT spending is still on premises. Azure's $80 billion annual run rate puts it in a strong position to challenge AWS for cloud supremacy. While Dalio trimmed his exposure to some of the flashier tech names, he went all in on a company that's quietly transforming itself into an AI leader. Bridgewater's stake in Salesforce surged a remarkable 107% in the first quarter, with the fund adding 500,000 shares, a clear vote of confidence in Salesforce's AI-driven future. AI traction. Salesforce's Agentforce, its new AI productivity platform, has already hit $100 million in annual recurring revenue, with 8,000 customers on board. Strategic acquisitions. The $8 billion acquisition of Informatica supercharges Salesforce's data integration capabilities, which are crucial for delivering advanced AI analytics. Margin expansion. Non-GAAP margins reached 32.3%, while free cash flow jumped 20% year-over-year to $6.5 billion. Despite a modest 8% year-over-year revenue increase, Salesforce's focus on profitability and AI-driven upselling clearly resonated with Dalio. Trading below its historical valuation averages, Salesforce offers a margin of safety rarely seen in high-growth tech. Its strong Rule of 40 score, balancing growth and profitability, and $60.9 billion in remaining performance obligations provide long-term visibility. For Dalio, this is the classic buy when others doubt opportunity. Now, the last piece of Dalio's tech trio is Amazon, a company that's, not just an e-commerce giant, but also a real powerhouse in cloud computing and artificial intelligence. Bridgewater actually increased its Amazon stake by 44% in the first quarter, picking up an extra 404,000 shares. The investment thesis here is pretty clear. AWS and Amazon's AI initiatives are well, just starting to hit their stride. Let's talk AWS dominance for a second. Amazon Web Services posted 16.9% year-over-year growth, pulling in $29.3 billion in first-quarter revenue and boasting a $117 billion annual run rate. Now, on the AI investments front, Amazon's custom Trainium chips deliver 30 to 40% better price performance than your traditional GPUs, making them especially attractive to enterprises that are, ramping up their AI workloads. When it comes to e-commerce resilience, everyday essentials actually grew at twice the rate of other segments, with Amazon's 138 million Prime members really driving unmatched customer loyalty. Dalio's move is right in line with Amazon's own $100 billion capital expenditure plan for 2025, with half of that set aside for AI infrastructure. Trading at a discount to fair value, Amazon's 64% jump in first-quarter earnings per share signals a powerful new phase of profit growth. And with an AWS backlog of $189 billion and AI adoption still in its early stages, Dalio sees Amazon as a cash flow machine just primed for a market re-rating. Dalio's first-quarter moves aren't about fleeing the tech sector. They're really about doubling down on the most durable, resilient, and strategically positioned tech companies out there. Microsoft's software moat, Salesforce's AI transformation, and Amazon's infrastructure edge all reflect a macro playbook designed to thrive, even amid stagflation risks and geopolitical upheaval. For investors, Dalio's message is pretty straightforward. In uncertain times, focus on companies with pricing power. Microsoft's 45% plus operating margins, well, they really set the standard. Then there's AI monetization. Salesforce's $1 billion plus in AI revenue shows real traction. And of course, global scale. Amazon's $155 billion in quarterly sales is just unmatched. While Dalio trimmed $3 billion from his SPY holdings, his $727 million bet on Alibaba and $319 million gold purchase, well, those moves signal broader diversification. But in tech, these three stocks are his high-conviction plays, cornerstones, honestly, for the next decade of innovation and growth. In summary, Dalio's latest portfolio moves are a masterclass in strategic rebalancing. He's not abandoning tech. He's really zeroing in on the companies best equipped to lead in a world defined by rapid change, technological disruption, and mounting global risk. For investors looking to follow in his footsteps, the lesson is clear. Bet on durability, innovation, and the ability to adapt.